Hello everybody and welcome to this video on understanding the concept of pool funds, wherein we'll also talk about the different type of pool funds. So what do we mean by pooling of funds? By pooling of funds, we mean that different investors, if they're institutional investors or if they're individual investors, contribute to the unit capital or the investable capital of an asset management company. The asset management company, headed by a fund manager and his trading and analysis team, will then invest this pooled capital into different asset classes, including foreign exchange, equity, money markets, bonds, commodities, etc. I'm your learning partner Sushila Hariharan, and I cover topics on trade life cycle, commodities, foreign exchange, OTC derivatives, as well as hedge fund accounting. In this video, we're going to discuss about the different types of pools of funds. There are 5 different types of pooled funds. The first one is the one that we've been talking about for almost a year, and that is hedge funds. A hedge fund is a pool of funds with individual contributions coming in from large institutional investors called as accredited investors, and the accredited investors invest the pooled capital in listed or unlisted stocks, bonds, as well as money market instruments. They trade aggressively in the derivative segment. They're also large traders in commodities, sometimes taking literally a percentage stake in the asset or in the company that they're buying into so that they get a board seat. Hedge funds are extremely aggressive traders as well as move in quickly in and out of different asset classes, taking in quickly profits as well as exiting losses once they see them. So hedge funds are large pools of capital, literally running into trillions of dollars, the largest amongst the largest being BlackRock as well as Carlyle Investments. The second category of pooled funds, okay, is private equity funds. Private equity funds are funds that are investing in unlisted stocks, unlisted bonds, unlisted commercial paper or certificates of deposit. The main objective of a private equity fund or a private debt fund is to stay invested for a long period of time. So if you look at the time horizon of a hedge fund, it could run into the life of the investment itself runs into a few months, okay, or maybe even a few weeks. But in the case of private equity or private debt, the lifetime of the investment runs into a few years. This is because the investor stays, the unlisted equity or the unlisted debt has to have some bit of a lock-in commitment from the investors. So under the private equity, private debt segment, you find investors who invest significant amount of capital into unlisted stocks, unlisted bonds. If they're in private equity, it is called as unlisted stocks. If they're aggressively investing in unlisted debt or unlisted bonds, it's called as private credit companies. So we understood the difference between private equity as well as hedge funds. So let's bring in a third entity into the picture, and that is our good old friend mutual funds, something that we're very, very familiar with. So while hedge funds and private equity funds are literally the big boys play, wherein individual contributions from investors run into millions of dollars, in the case of mutual funds, the contribution of the investors is a much, much smaller. Okay, in fact, investors can even contribute as little as 5,000 rupees or the equivalent of $500 to participate in a mutual fund. The main objective of mutual fund is to give the principles of diversification, asset allocation, and portfolio management to the small and retail investor. So in the case of a mutual fund, it helps that the mutual fund stay invested in the assets that it is investing in, whether it is listed companies, unlisted companies, and most importantly, they do not trade aggressively in derivative segments because they could lose money in some of the exotic options or exotic structured products. And it's important that they do not lose money because mutual funds are meant for small and retail investors who do not have a very high risk-taking capacity. So we have on the side of large individual contributions, we have We have hedge funds and we have private equity funds. And on the side of the small retail individual investor, we have the case of mutual funds. Within them, they have different structures. So, for example, within a mutual fund, you could have a bond fund, a money market fund, a growth fund, a diversified fund. That is something which is going to be discussed at later. But once we understand the concept of pooling of capital, then we understand that we trust and have faith that the fund manager will outperform the underlying indices and therefore generate a higher return to the investor. A fourth kind of pooled funds is venture capital investors. Venture capital investors are those investors who are like hedge funds and private equity funds, literally combined together. Okay, so VC funds, as they're popularly called, and you may have seen a lot of them if you're watching the show Shark Tank, are those investors who invest large sums of money, but in a very select and a very elite group of companies or investments. The whole objective of VC funding is to help the company grow in business. Okay, so it's not so much for the accumulation of capital as much as it is for helping the underlying business grow. So again, VCs is a large investor play. Okay, so that brings us to three different categories of pooled funds which are invested by large investors, that is private equity funds, venture capital funds, and hedge funds. Okay, so private equity or private debt funds invest in unlisted stocks, unlisted bonds. Hedge funds invest in listed stocks, listed bonds, foreign exchange, commodities, derivative trades, etc. And between these two, between private equity funds and hedge funds, typically a pre-IPO kind of a fund would be a venture capital fund, a fund that invests large sums of money to help growth, to help diversification, to help creation of valuation for the existing investors. And finally, the last category of investments, which is available to both individual investors as well as large institutional investors, is REITs, a topic that is gaining much traction in industry worldwide, and that is real estate investment trusts. The name itself suggests what kind of investments they're going to make. They're going to make exclusive investments into real estate. So therefore, REITs are also structured like pool of capital. They generally are subscribed to by large number of individual investors, and at the same time, the REITs have a significant amount of investments made from that pool of capital into real estate. Within that, there is a categorization of commercial real estate as well as, commercial REITs and residential REITs. About the different types of REITs, we'll be having another video, but I needed you to understand that there are 5 types of pool funds. The first one is private equity, private debt funds. The second one is venture capital funds. The third one is hedge funds. The fourth is REITs, and the fifth is mutual funds. The whole concept of pooling capital is extremely distinct and different from portfolio management services. Portfolio management services takes into consideration an individual's portfolio. We have very many high net worth individuals, whether they are sports stars, industrialists, startups, film actors, celebrities, YouTubers, who have tons of capital to invest in, and they contribute the capital to a single portfolio manager, and the portfolio manager's job is to grow that portfolio. As opposed to pooling that capital, they have to grow the existing portfolio or create a portfolio and grow that portfolio. If you like this video, do subscribe to my YouTube channel and share it with your friends. Thank you so much.